For the first time in nearly 3 years, the European Central Bank has raised interest rates. On the 11th of June 2026, the Governing Council lifted its 3 key rates by 25 basis points, pushing the deposit facility to 2.25%, the main refinancing rate to 2.4%, and the marginal lending rate to 2.65%, all effective from the 17th of June. Think about what that really means. Between June 2024 and June 2025, the ECB cut rates 8 times in a row. Now, in a single move, it has slammed the brakes and gone into reverse. This is not a routine tweak. It is a signal that the economic ground beneath the European Union has shifted dramatically, and the consequences will ripple through every major economy on the continent. Here is the detailed picture, and why the EU's biggest nations could come out ahead. So what forced the ECB's hand? The answer is inflation, driven largely by an external shock. The conflict in the Middle East, centered on Iran, has pushed energy costs sharply higher, and that has fed straight into European prices. Flash Eurozone inflation for May 2026 came in at 3.2% year-on-year, up from 3% in April, and the highest reading since September 2023. That is well above the ECB's 2% target, and crucially it is moving in the wrong direction. The Governing Council described its decision as robust across a range of scenarios mapping how the shock might evolve. In plain English, policymakers concluded that ignoring this surge would risk letting inflation expectations become unanchored. Faced with imported energy inflation, they chose to defend the euro's purchasing power, even at the cost of slower growth. The ECB did not just raise rates, it gave us a roadmap. In the latest Eurosystem staff projections, headline inflation is expected to average 3% across 2026, then ease to 2.3% in 2027, before settling back at the 2% target in 2028. That trajectory matters enormously for households, businesses, and investors trying to plan ahead. It tells us the ECB expects the energy shock to be painful but temporary, with prices gradually returning to normal over roughly 2 years. For borrowers, it suggests rates may not climb much further if the forecast holds. For savers, it means real returns could finally turn positive again. And for the EU's larger economies, this controlled disinflation path is the difference between a manageable squeeze and a damaging wage price spiral. The credibility of that forecast is now the ECB's most valuable asset. Now for the uncomfortable part. The Eurozone economy actually shrank by 0.2% in the first quarter of 2026, revised down from an initially reported 0.1% growth. That marks the first contraction since the fourth quarter of 2022 and the sharpest decline in years. The causes are familiar: tight energy supply, rising inflation linked to the Middle East conflict, and the anticipation of monetary tightening. This creates a genuine policy dilemma. The ECB is raising rates to fight inflation at the very moment growth is stalling, a textbook stagflation risk. Yet the picture across member states is far from uniform. Some economies are still expanding, while others are slipping backwards. That divergence is precisely why the question of which big countries benefit is so important, because a single interest rate now applies to economies moving in opposite directions. Let us start with the largest economy, Germany. In the first quarter of 2026, Germany expanded by 0.3%, a modest but welcome positive after years of stagnation. Looking ahead, following 2 years of recession and growth of just 0.2% in 2025, German economic activity is set to expand by around 0.6% in 2026. That may sound unremarkable, but for an economy that had become Europe's underperformer, it represents a genuine turning point. Germany's export-heavy manufacturing base has been battered by high energy costs and weak global demand, so even a gentle recovery eases pressure across the whole bloc. A stronger euro, which we will come to shortly, makes imported energy cheaper, and that disproportionately helps energy-intensive German industry. For Berlin, the combination of stabilizing growth and a firmer currency is a quietly favorable mix. France presents a more mixed but resilient story. The French economy contracted slightly, by 0.1%, in the first quarter of 2026, weighed down by the same energy shock affecting its neighbors. However, after growing 0.8% in 2025, France is projected to grow at that same 0.8% pace across 2026. That makes France one of the more stable major Eurozone performers, outpacing Germany's expected rate. France's relative strength stems from its diversified economy and, importantly, its heavy reliance on nuclear power, which insulates it somewhat from imported fossil fuel inflation. While households still feel the squeeze on real incomes, the structural energy advantage means France is less exposed to the very shock-driving ECB policy. In a year defined by energy security, that domestic generation capacity is quietly proving to be one of Paris's most valuable economic assets. Now we reach the development that could genuinely reshape who wins. Beyond monetary policy, the EU has launched its most ambitious fiscal pivot in years. The ReArm Europe plan, also branded Readiness 2030, was presented by Commission President Ursula von der Leyen in March 2025 and aims to unlock up to €800 billion in defense investment. At its heart sits a new instrument called SAFE, Security Action for Europe, through which the Commission will raise up to €150 billion on capital markets to lend to member states. This is effectively a continent-wide spending surge, and it lands at the exact moment private demand is weak. Public money flooding into defense, infrastructure, and industry can offset the contraction we just discussed. For the EU's largest economies with the biggest industrial bases, this represents an enormous opportunity. The mechanics here are crucial, so let me make them clear. The 800 billion figure comes from two sources. First, the SAFE instrument provides €150 billion in cheap loans for missile defense, drones, cybersecurity and ammunition. 18 member states have already expressed interest, with initial requests totaling around €127 billion. Second, and arguably more powerful, is the activation of the National Escape Clause in the Stability and Growth Pact. This allows governments to raise net spending by up to 1.5% of annual GDP on defense without breaching the EU's normal fiscal rules. In simple terms, Brussels has temporarily torn up its own budget restrictions to let countries spend. For large economies with the fiscal headroom to take advantage, this is a once-in-a-generation license to invest at scale, and they are seizing it. No country illustrates the benefit better than Germany. Following a historic reform of its constitutional debt brake, Berlin has committed to a dramatic escalation in spending. German defense funding is projected to reach €117.2 billion in 2026, rising to €162 billion by 2029, equivalent to around 3.2% of GDP, or roughly 3.5% once broader defense-related items are included. Consider what that means in practice. Germany possesses Europe's deepest industrial and engineering base, so a vast share of this money flows straight back into German firms, German jobs, and German innovation. The very stimulus the economy desperately needs is now arriving through the defense budget. After years of being labeled the sick man of Europe, Germany is positioning itself to be the single largest beneficiary of the continent's rearmament drive, turning a security challenge into an industrial revival. France and Italy are not far behind. France has committed €8.5 billion to expand its ammunition and drone stockpiles under its updated military planning law, including a striking 400% increase in explosive drone stocks before 2030. With its world-class defense champions, much of that spending stays within French industry. Italy, meanwhile, plans to double its defense spending to 3% of GDP over 4 years, and the cheap financing is a major prize. Analysts estimate the SAFE loans could hand Italy an annual interest subsidy of around €675 million, money saved purely because the EU borrows more cheaply than Rome can alone. For a country with high public debt, that subsidized borrowing is genuinely transformative. So the three biggest Eurozone economies each capture a different advantage: Germany scale, France industrial depth, and Italy cheaper money. There is one more channel of benefit worth understanding: financial markets. The ECB's rate hike, combined with global uncertainty, has supported a stronger euro. Analysts suggest that if Eurozone growth proves stronger than 1.3% and inflation rises only slowly, the euro-to-dollar rate could test levels above 1.20. A firmer euro lowers the cost of imported energy and raw materials, directly easing inflation for every member state. Tellingly, the wave of U.S. tariffs introduced in April 2025 actually triggered an appreciation of the euro alongside traditional safe havens like the Swiss franc, a sign investors increasingly view European assets as a refuge. Meanwhile, the credit quality of German government bonds remains a magnet for capital, with their convenience yield rising from around 60 basis points in 2023 to roughly 90 basis points in 2025. Stability itself has become an export. So let us pull this together. June 2026 marks a genuine inflection point for the European Union. The ECB has chosen to fight imported inflation, accepting weaker short-term growth, while Brussels simultaneously unleashes up to €800 billion in defense and industrial spending. The combination is unusual: tighter money but looser fiscal taps. The clear winners are the economies with the industrial capacity and fiscal credibility to absorb that spending. Germany gains the most through sheer scale and a reviving manufacturing base. France benefits from energy resilience and strong defense industry. Italy gains from dramatically cheaper borrowing. Smaller economies will share in the loans, but it is the big three that capture the lion's share. The lesson is simple: in this new era of European spending, size, industry, and credit standing decide who profits. Keep your eye on those fundamentals, and you will understand where Europe is heading next.